Net deferred tax expense or benefit. The difference between the change in deferred tax asset and the change in deferred tax liability is the net deferred tax expense or benefit. Observe the following using the preceding illustration. Tax benefit from increase in deferred tax asset is 180,000 less tax expense from increase in deferred tax liability 90,000. So the net deferred tax benefit is 90,000. Needless to say, the tax expense from the increase in deferred tax liability is more than the tax benefit from the increase in deferred tax asset. There is a net deferred tax expense. Current tax liability and current tax asset. A current tax liability is the current tax expense or the amount of income tax actually payable. This is classified as current liability. Under our income tax law, income tax for corporation is payable every quarter. If the amount of tax already paid for the current period exceeds the amount actually payable for the period, the excess is recognized as a current tax asset. Actually, a current tax asset is a prepaid income tax and shall be classified as current asset. A current tax liability or current tax asset shall be measured using the tax rate that has been enacted and effective at the end of the reporting period. Presentation of deferred tax asset or liability. PAS 12, paragraph 70 provides that when an entity makes a distinction between current and non-current assets and liabilities, it shall not classify deferred tax assets as current assets and deferred tax liabilities as current liabilities. Accordingly, a deferred tax asset shall be classified as non-current asset and a deferred tax liability shall be classified as non-current liability regardless of reversal period. Moreover, a deferred tax asset or deferred tax liability shall not be discounted. Offset of deferred tax asset and liability. Under PAS 1, assets and liabilities shall not be offset unless required or permitted by another standard. PAS 12, paragraph 74 provides that an entity shall offset a deferred tax asset against a deferred tax liability when the deferred tax asset and deferred tax liability relate to income taxes levied by the same tax authority, or the entity has a legal enforceable right to set off a current tax asset against a current tax liability. Measurement of deferred tax asset or liability. A deferred tax liability or deferred tax asset shall be measured using the tax rate that has been enacted by the end of the reporting period and expected to apply to the period when the asset is realized or the liability is settled. For example, the tax rate of 30% is applicable to the taxable year 2020. By December 31, 2020, a new tax law has been enacted imposing a 25% tax rate effective taxable year 2021. The current tax liability or current tax asset is measured at 30%, but the deferred tax liability or deferred tax asset is measured using the new enacted tax rate of 25%. Intra-period and inter-period tax allocation. Intra-period tax allocation is the allocation of income tax expense to the various revenue that brought about the tax. Thus, the total income tax expense is allocated to income from continuing operations, income from discounted operations, and prior period errors or items directly charged or credited to retained earnings. Intra-period tax allocation is the recognition of a deferred tax asset of a deferred tax liability. Statement of financial position approach. To account for a deferred tax asset or liability, a statement of financial position that shows all the assets and liabilities at their carrying amount is first prepared. So here is the procedures. Step 1. Determine the tax base of the assets and liabilities in the statement of financial position. Step 2. Compare the carrying amounts with the tax base. Step 3. The difference between the carrying amount and tax base normally will result to a deferred tax asset or liability. Step 4. Permanent differences do not give rise to deferred tax asset or liability. Step 5. Apply the tax rate to the temporary differences. Step 6. Determine the beginning and ending balance of deferred tax asset or liability. And the last, recognize that the net change between the beginning and ending balance of deferred tax asset or liability. Comprehensive illustrations. On December 31, 2020, the accounts of EC Company have the same basis for accounting and tax purposes except computer software cost. The carrying amount is 4 million less tax base 0, so the difference is 4 million. And the building is carrying amount 47,500,000 less tax base 45 million, so the difference is 2,500,000. In January 2020, EC Company incurred cost of 5 million pesos for the development of a computer software product. Considering the technical feasibility of the product, this cost was capitalized and amortized over 5 years for accounting purposes using the straight line method. Computer software cost 5 million less amortization for 2020 1 million. So the carrying amount on December 31, 2020 is 4 million. The computer software costs have a 0 tax base because the total amount was expensed in 2020 for tax purposes. The building was acquired on January 1, 2020 for 50 million pesos and depreciated using the straight line at 5% for accounting purposes and 10% for tax purposes. Building worth 50 million less accumulated depreciation 2,500,000, so that the carrying amount on December 31, 2020 is 47,500,000. And building 50 million less accumulated depreciation, the 50 million times 10% is 5 million. So the tax base on December 31, 2020 is 45